Meet Barbara. She's been living in this house for over 30 years. It holds her favorite memories, but as she enjoys her retirement, she's finding that a little extra cash would make daily life much more comfortable. Like many homeowners her age, Barbara worked hard to pay off her house. For decades, she sent a check to the bank every single month until that final payment cleared. This chart shows how a traditional mortgage works. As Barbara made her payments, the red bar, representing her debt, steadily shrank. At the same time, the green bar, representing her equity, grew until it filled the entire space. By sticking to that monthly routine, her house acted like a giant piggy bank. She built up decades of value, brick by brick, over her entire career. Now that she's retired, Barbara wants to tap into that built-up value without having to pack her bags and move. So she takes out a reverse mortgage. A reverse mortgage flips a traditional loan upside down. The bank siphons the home's value and drops it into Barbara's account. But because interest and fees are added daily, the water level in her house bucket drops, while her debt meter climbs higher. Let's fast forward 5 years. Barbara's grandchildren are growing up in Florida, and she decides she wants to move down south to be closer to them. The big question is, now that she has a reverse mortgage, is she allowed to sell her house? The answer is a definite yes. There is a common misconception that the bank takes ownership of your property when you sign the paperwork. In reality, Barbara still owns the house completely. The bank just has a legal claim against the home for the unpaid portion of the loan, exactly like a normal mortgage. Setting up a reverse mortgage doesn't mean you hand over the keys. It simply changes the direction the money flows. Barbara holds on to her rights as a homeowner, including the freedom to put a for sale sign in her yard whenever she feels ready. When Barbara decides to list her property, the buyers walking through her front door won't know or care about her loan. To the active real estate market, her home looks exactly like any other house on the block. The real difference happens behind the scenes, and it takes place in 4 steps. Step 1 is calling her mortgage company to request a payoff quote. This document is crucial. Because reverse mortgages accumulate interest and fees every single day, the amount Barbara owes today is higher than the amount she originally borrowed. She needs an exact, up-to-date number. Step 2 is the familiar part. She hires a real estate agent, takes nice photos, lists the property, and accepts a buyer's offer. At closing, the buyer's payment splits in 2. The first pile goes to the bank, completely paying off the reverse mortgage balance. Step 4 is the reward. The remaining pile slides over to Barbara, ready for a down payment on her new condo. When you look at the whole picture, selling a home with a reverse mortgage operates like a standard real estate transaction. You simply have to verify that constantly growing loan balance and clear it out before you collect your final check. But we need to look at the worst-case scenario. Imagine the housing market takes a sudden dive, and property values in Barbara's neighborhood plummet. Because her loan balance has been ticking upward every day, what happens if the amount she owes the bank grows to be larger than the actual current market value of her house? This is where a built-in safety net comes in. Because these loans are backed by federal insurance, they include a feature that protects you if the house is no longer worth enough to cover the debt. This is called non-recourse protection. If Barbara sells the home for its fair market value, the insurance slides in to cover the entire missing amount. The scale is balanced. For Barbara, this means the bank can never knock on her door demanding she empty her personal checking account to make up the difference. They can't touch her retirement funds, and they can't pass the debt down to her children. That built-in insurance ensures that even in a market crash, Barbara will never owe more than the house is worth. The property itself absorbs the market risk, limiting her personal financial risk. Fortunately, her market remains strong. She sells her home, pays off her reverse mortgage, and is happily packing for the move to Florida. Keep 2 main things in mind. First, remember the backward math. Your debt goes up and your ownership level goes down over time. Second, you always own your home, can sell without penalty, and are protected by insurance if the market crashes. If you are curious about how these numbers might look for your own home, reach out to an approved reverse mortgage counselor or a trusted real estate professional. Getting a clear picture of your exact rights takes the mystery out of the process. It turns a complicated loan into a practical tool, helping you reach your next chapter and your ultimate goals with complete confidence.